Okay, finally, at last. I don't know if YouTube's a little slow tonight or if it's on my end or what exactly it is. But we're here. Welcome, folks, to the Naples Vice channel. And hopefully the audio is a little bit better. I made an investment in an actual microphone. So hopefully that solves that problem. What a day. Not necessarily price-wise. In the U.S., the Dow was up about 30 points, or about a tenth of a percent. S&P up 9, 1/3%. Nasdaq up about 38 for about 0.4%. Asia right now is mostly higher. The Shanghai is slightly lower, down about 0.1%. The Hong Kong Stock Exchange, wow, blowing up almost 1.4% or 366 points to 2711. Wow. Nikkei up about 50 or 0.2%. Nikkei's been holding in a little bit of a range. I've been watching these Chinese stocks lately as sometimes I can give you a little bit of a bearing of what's going on in Asia, especially with the trade deal being something that really has been weighing down on this market. I didn't do anything yesterday. There wasn't a great deal of news items. We did have quite the reversal when I went live on Monday night. I had some puts on the S&P futures. They sold them pretty hard overnight. And once again, it's all this trade speculation. Nothing material on that front yet. Something was floated out that China expects the U.S. to roll back the tariffs. As we know, the tariff increases go into place on the 15th, which is Sunday. And a rumor got floated out that supposedly they're going to get rolled back, and then that sent stock futures go from being down near 20 points to being up almost 6. As we can see, the trade really is the kind of news item that's driving this market right now. Later on in the day, on Monday, the White House comes out. Larry Kudlow, or one of the stooges in the White House, came out and said that, whoa, not so fast. We don't want to jump the ship and so forth. And that kind of kept stocks lower, but the futures did really retrace a lot of their losses. And today is really the big story, because there's two factors that we have to consider in this market. Number one, it's a trade situation, and number two, it's the Federal Reserve. I think the Fed, honestly, plays a much bigger impact, especially in a late cycle market like this, where we just keep seeing high after high after high after high. We're 11 years into this thing. So what did we get from the Fed today? Well, nobody was expecting a rate cut. I mean, that was pretty much known that we weren't going to get a rate cut today. And the FOMC kept the Fed funds target at 1.5 to 1 3/4. So no change there. No big surprise. In terms of economic data, I don't bother with any of that, and the reason being is that, and Jerome Powell said this himself today, when it comes to the dot plots, and we're going to get future rate cuts, etc., we're flexible. Straight from the mouth of the beast, we're flexible. So when they say, there's not going to be rate cuts until 2021, I don't buy it. It's just not, it's not realistic. And even Powell himself today said that, we don't know what the conditions are going to be like going that far out, especially in the kind of market that we have today, and the kind of economy that we have today, where a lot of the numbers, a lot of the figures that come out are questionable. So the really fascinating thing was the remarks from Jay Powell. Now, all over the news, I got CNBC up here right now. Powell emphasizes Fed not moving off the sidelines unless inflation heats up. Here's another one. Fed decision, interest rates left unchanged, indicates no change through 2020. And that's exactly what I'm talking about. That's why you got to get beyond the headlines if you really want to have any kind of a bearing on what's going on here. See, Asia stocks mostly higher as Fed signals low rate hikes in 2020. So, where did the real data come from? Where did the real kind of meat of this whole FOMC meeting, et cetera, come out? Well, that's in the press conference from Jerome Powell. And wow, was he ever, I can't even think of an appropriate word for it on how to describe Jay Powell's tonality today, how to describe how he was talking to the market. He was just, it was almost like he was talking to every single bull out there and saying, hey, buy this market. We're going to continue to be accommodative. We're going to continue buying bonds. Inflation's a lot lower than our target, and we want to reach our target rate with inflation. So what does that mean? They're pumping money into the bond market, and he is blatantly saying it now. They don't even hide it. It's not even a question of whether or not they're doing it. It's quantitative easing. It is. They just won't say it is. And they're going to keep doing it. They can't stop at this point. Another big subject was the repo market. They tried to play it off like they're going to be tapering their involvement in the overnight lending market. Well, we'll see if that's true. I don't think it's going to happen. Right now, with all this repo that's going on right now, these repurchasing agreements of Treasury securities, basically they're just injecting capital into the banking system, bailing out the banks again. Except this time, they're not going to Congress. They're just going straight to the Federal Reserve, who they tax you through inflation. They take your purchasing power instead of doing a massive, what was the number in 2008? $700 billion, some kind of obscene number to bail out Wall Street. Well, they're doing it right now, right? When the Fed's getting involved in the banking system like this, and they're buying assets, and they're what they would say liquefying the reserves, or propping up reserves. You name the little jargon that they want to use. Basically, they're making this market move, and they're re-liquefying the banking system. They're buying bonds, which is surprising to see the U.S. 10-year right now up. The yield up 0.01, sitting at 1.8%. Not that we're really surprised. That's one thing that I'm going to be really watching now. I want to watch the bond futures, because the bond futures have been going down, whereas in the physical, the actual bond market yields just continue to go higher. Just fascinating. I'm pulling up a chart right now of the U.S. 10-year Treasury over the last 6 months, which really, when you look at the chart, it's really been range bound for quite some time, since about, I'd say about August. We're sitting between 150 and 190 on the 10-year. It's bouncing around in here quite a bit. But it's considering the fact that the Fed is out here buying all these bonds, you would think, but here's the thing. You got to play the market that you have. Even though I'm a big fan of paying attention to the news, paying attention to everything that's going on around you, if you're trading those bond futures, they have not been your friend. Another market today that was pretty fascinating was a gold market. Gold soared. Gold futures they're up about $12 on the futures close at 5 o'clock. Really rallying, and gold's up another almost $5 here at this point, trading at 1479.70 an ounce. And really, I think this is a great case to get long gold out of here. Gold had that massive run really at the beginning of the year. I got all my figures. There's so many numbers. That's why I like to watch one market at a time. But when you got a situation like this one, you can sit here and look at gold. Okay, so we got gold topping out here at about 1566 the ounce. And looking at the daily chart on gold, we have been kind of in a little bit of a consolidation range here. Gold hasn't really sold off quite the same way that it went up. I mean, we haven't really seen it's been a slow, choppy move to the downside. I'm looking at the daily chart. I mean, we had sort of a double bottom pattern here. If we go up and break, I figured 1490 on the gold chart, man, I'm looking for at least about 1520 at that point. And if the Fed continues to be this dovish and continues to want to hit this, quote, inflation target of, I believe it's 2%, I don't believe the inflation number either. That's the government number, so that's what I'm quoting here. I think 1530 will be a walk in the park. After we get up above that 1520 level, at which point, if we can get back to 1530, I'm pretty confident we're going to go back up and test that 1560 area of the high. And after that, I mean, we can do a little bit of Fibonacci work to try to, see like a 1272 extension of the move, which I don't, Fibonacci is a great tool. Some people love it. I don't really care for it because I prefer to be more situational. We got a 1650 target at the 1272, which is about 30 points off of another level that I have here. Going out the weekly chart of gold, we actually have if you believe in the twos going above the ones as a buy signal on the sequential system, we have that setting up right now. And it almost looks like a breakout on gold because you have kind of a consolidation. You got dojis in there. You got small ranges, with last week being a head fake. They took it up and they sold it back off. So once again, our level to watch in the gold market is about 1490, because I would take out last week's high on the weekly chart. And at that point, I'd be really bullish gold. I'm looking at possibly doing some put spreads in here. I want to go about 60 days out and try to get some premium out of here. I don't believe gold implied volatility is very high. It's usually not, especially after a move like this. The other story in the precious metals land is silver. Same story for silver. We had the massive run up to almost $20 an ounce, which is going to be a huge resistance level. I see them. They keep printing a set of trend up there as a resistance. Silver kind of had the same, so it's just more volatile. You look at the chart, it looks almost identical to gold. The swings, just on a percentage basis, tend to be more extreme. So silver was up today around 23 cents at the futures close. We gapped about another 10 cents higher in the silver market. If I had a choice of being in gold or silver, I would pick silver any day. The only problem with silver is that you have very limited amount of options, pun intended, when it comes to trading vehicles. I mean, you have the futures, which with a 5,000 delta, it's very difficult to trade in a small account. I mean, a 10-cent move in silver, that's $500 a contract, and that's, unless you're trading a pretty sizable account, $50,000, I'd say I wouldn't be doing it. You can get some futures, but excuse me, some options on the futures, which imply volatility in silver. And I know this because I've been doing a little bit in the silver futures options. Implied volatility in silver is only about 7, which, if you look historically at silver implied volatility, that is extremely low. Usually silver's sitting about 40, 50. When you start getting into a big run, it shoots right up to 100. So you can get some out of the money options on silver for really a decent price, even with a little bit of time inside of them. Another story is the soybean market. So China supposedly was buying, they have some private soybean crushers in China that have been buying a lot of U.S. soybeans. And as I said before, soybeans are kind of the core of the Phase 1 deal. Agricultural products are really the basis for the beginning of the whole trade kind of situation right now. They are pulling back a little bit. They were down about 9 cents today. But, I mean, you get a 9-cent pullback off of really about a 30-cent rally off the bottom, which, by the way, setup trend held soybeans. I know I said that before when I was talking about them, but it's just a tremendous. When you see something that just works like that to a T, it just really kind of blows your mind. So we're pulling back on beans. I don't have a particular level I'm looking at for a pullback on here. As soon as I see kind of an engulfing kind of day, or I see a little bit of strength coming off, I want to be back in the soybean market for sure. Another thing going in soybeans, I'm not looking at USDA reports. I'm not looking at anything necessarily fundamental, but you can see that there's a lot of funds right now, a lot of managed money that is very short soybeans. And when that happens, well, beautiful things happen because we start getting a lot of short covering. And I think that's really what began the portion of this rally. Targets on soybeans, I'm looking at 912. If you get in, say we get back to around 890 area, that's a 20-point rally. I mean, that can be really some good profits in the options. And the soybeans is another example of a pretty low implied volatility situation. I know they pumped those soybean options implied volatility all the way as high as 26, so from 7, which that alone is enough to give you a pretty good profit. That's still pretty low compared to where beans have been. So you can still get some pretty cheap calls in there. And as the price of soybean goes up, implied volatility in commodities, here's just a little fun fact for you. Implied volatility in commodities tends to rise when things go to the upside versus equities, where they tend to go to the downside. Implied volatility, really starts to rise. Looking at those NASDAQ futures, I'm far more of a bull in the equity space. I'm far more of a bull in the NASDAQ right now than I am in the ES. The NASDAQ had the best reaction today to the Fed, which, if you're getting cheap money and you're in a risk-on environment, the NASDAQ is exactly where you want to go. The Dow, as I said, it did finish up, but the Dow really was a loser the majority of the day. We had a pretty bad forward guidance coming out from Home Depot, which I'm not too utterly surprised, but I don't think that that's going to keep that stock down very long. Not with all this liquidity coming out from the Federal Reserve. That's the problem with the Dow. That's why I don't like trading the Dow, is because single stock events can have such a big impact on the Dow Jones. And in my eyes, I'd rather be in something like the S&P, where That's 500 stocks, even though it's market cap weighted, okay. But unless it's a stock like Apple, which even if Apple goes down, the S&P can still be up. So they always preach diversity, all these financial advisors, all these people. But the thing is that when you're trading indexes, I don't want sensitivity, and it's important to have a little bit less sensitivity to individual stock risk when you're trading the indexes, especially when you have a ton of leverage on, when you're in options, you're in futures. You have enough risk from the leverage. You don't want all that risk from single stock risk. Final instrument I want to go over today. I don't really care about bonds right now, despite the fact that the Fed said that they're going to be doing some pretty wild things in the bond market. Is crude oil. Oil just has been a little bit strong here in the last couple of weeks, continuing to move higher, making higher lows, which is beautiful. We still have quite a bit of problems here. We're not even near the 60.5 level yet that we need to break in order to really get oil moving to the upside. We did have the Aramco IPO, which could give a little bit of an incentive perhaps to the Saudis if they want to keep the valuation of that company up, to at least keep crude oil somewhere in the $60 area. Because, what is Aramco? It's just a giant oil company. So there could be a little bit of an incentive for there to try to keep oil higher. If the Fed really starts cranking up inflation here, that could likely have an effect on crude oil, which would be bullish for the oil situation. Right now, we're just kind of chopping around. It looks to me like oil's waiting for some kind of news event. The most recent rejection, which, what do you know, is a setup trend line at 59.86. So, we got pretty close to that upward bound of this tight range that crude's been in for quite some time. What we really need to see is some kind of big demand, some kind of situation where we put a lot of demand into this market, because OPEC they've excuse me, on the supply side, we have OPEC cutting back on supply. They're doing that 500,000 barrel per day production cut, which is phenomenal. Now we just need something either extreme on the supply side or something on the demand side to just get oil out of this range. I want it to go down. That's what I want, because I want to fill my gas tank for cheap. I don't know about you, but if we get above 60.5, I think we're looking at $70 oil again. Based on the size of this range, we got about a $10 range, and the general rule of range breakouts and wedges and things like that is the highest price differential in the range or the wedge or etc. So that could take crude oil up to 70, and that's all based on a technical number. I get all my price targets for technical reasons, and I justify my trades with the fundamentals. That's techno fundamentalism 101. And we got a little, I guess you could call it trend line going to the downside. I think breaking above the 60.5 level in crude will be more than enough to break that irrelevant kind of two-touch trend line we have set up there. And I said that was going to be the last one, but I don't think it's going to be, because the dollar today, wow, did it get just... dollar got decimated. Of course, that's what you would expect. And with that, the euro just, it just took off to the moon. So we have a 97, and this is the DXY. And let me make sure I don't have the CFD, because I want the actual index. There we go. That's the actual index, which is sitting at 97.12 right now, which is actually, we've come back and we've tapped that level multiple times. That could be a pretty good support out of here, as well as there being actually a 9 on the daily chart, which, if you're a time to mark guy, that means it's time to start selling puts, or buying maybe some calls on, name the currency of your, excuse me, you want to be selling calls on other currencies or buying puts in that situation. Weekly chart of the dollar, because this will actually have an impact on crude. It looks pretty bad actually. On the weekly chart of the dollar, we have a 2 going below 1, lower high, rejection that set up trend, which does not bode well for the dollar. Like I said, we're sitting at a pretty dense support level on the daily chart, so we're going to have to see what happens there. Generally, I tend to be a dollar bull, not because I think the dollar's worth anything, just because I think that currencies around the world tend to be much weaker. And if you look at the interest rate situation around the world, many countries out there have negative interest rates or far lower interest rates than the US dollar. And I think that's argument enough for this thing to, for the dollar to hold some strength. And it's still considered a safe haven for some reason. And, that takes me over to the euro. The euro's breaking out, actually, to the upside from what it looks like. I mean, I probably wouldn't be a buyer of the euro until at least 112. This is the euro futures. I watch the CME products. I don't trust a lot of these Forex brokers online. You look into a lot of these, they're in sketchy places. They don't have a lot of regulatory clarity on how they operate, so I don't trust your traditional Forex brokers. So all the quotes, currency wise, that I give you will be CME futures products. So on the continuous contract for euro futures, it looks like they're breaking out from here. But like I said, I want to see them. I want to see what happens at 112. There's a pretty incredible amount of resistance in that area, and I just would be very weary of too much long side on the euro. So from there, like I said, I continue to be a bull on the stock market, turning bullish on gold and silver. I don't have really a whole lot to say about the bond market right now. I think the best thing to do with the bond market is to just stay on the sidelines for now. And crude oil, 60.5. Until then, there's just not a lot to say unless we start seeing a lot of weakness from here. If we get to 60.5 and we start seeing a lot of weakness in oil, or they do some kind of news, something of that nature, call spreads all day long, sell them. That's what I'll be doing. And you should do your own research and make your own choice to figure out if that's a good idea for you. Because, hey, I'm just a guy on the internet. You should not put your money at risk because I say something. And last but not least, soybeans, looking for a pullback buy, looking for more short covering from the managed money. And with that, I'm going to go ahead and leave you. Happy trading, everybody. Good luck out there. Let's make some friggin' money.